Hello, everyone. Welcome to another episode of Firm Discussions. I'm joined today by Andrew Marshall of Capital Mindset, and we're going to talk about International Working Group, or IWG. So before we get on to talking about the company, Andrew, maybe you could give listeners a little bit of info about your background and Capital Mindset.
Sure. So I'll start on myself first, then we can talk about capital mindset. So just a quick background. I work in the finance space. Started off working retail trading, so doing options trading on retail accounts back in, I don't know, 2015, 2016. Got my, had my FINRA licenses, all that good stuff. And then went back into corporate finance. Um, so I have my CPA. I'm now the finance officer or CFO for kind of a mid-size um, nonprofit. And so, yeah, that's kind of like my background. And so obviously through working with these accounts, doing kind of the trading on them and everything, being involved in that space, I got interested um, in the market. It's kind of my job. I was looking at it, 10 hours a day. And so um, then it just kind of researching stocks, all that, along with my finance background, led me to kind of find other people on the internet. So I met Fabio from Capital Mindset. He's the one that originally started it. But what it is it's an investment community. So what we do is we have a few analysts, myself, Leo, and Fabio. And then we also have the community where we kind of have discussions, have talks about, different stocks or positions that we think are interesting. And yeah, so that's kind of the quick and dirty on my background there.
Good stuff. Yeah, and you do quite a lot of quite a lot of videos on YouTube as well.
Mm-hmm.
Through that, which is just quite good. And longer streams and things, live streams and stuff like that, which I've watched a couple that you sent over and a few others. It's been quite interesting stuff. So yeah, let's maybe start the discussion on IWG then. So maybe we can start off by having an overview of the company, what it does, where it operates, all that kind of stuff.
Sure.
And you wanted
So
to, you've got some slides prepared, so
mhm.
are you able to share the screen still? Or
No, I think you just have to make me host and then I can share.
wait a second.
We keep passing the host back and forth.
Oh, I've just tried changing. Can try it now.
There we go. Perfect.
Yeah, I just changed the settings on it.
Okay. So quick background on IWG, where the industry that they play in, and who they are. So IWG is International Workplace Group. You may know their brands Regis, Spaces, HQ, Signature. So let's see. Just really quickly on the background of the company, they were founded in 1989 by Mark Dixon, who he's from England, an English entrepreneur, which is why, even though they're headquartered in Belgium, they're listed on London Exchange. I would say they're primarily you think of them as a London or a UK based company. A way to think about them is think they're similar to WeWork. So they're um, like space as a service is the joking, term, or they hybrid workspace. The only difference is that IWG has obviously been around a lot longer, and it's a more sustainable model. So where WeWork is currently, it looks like they might be going through Chapter 11 bankruptcy filings. IWG right now is in the clear and doing well. And if anything, the situation at WeWork would be a tailwind for them. We'll talk about that later. But just a quick, piece of evidence showing how they're different is the way IWG has structured their business was so that in 2020, when the whole world just shut down, what IWG did was they set up all their leases because just like WeWork, they lease out a floor on a office building and then they sublease that out. Well, when COVID happened, no one's going into these hybrid workspaces. And the way IWG structured their entities is instead of having all these leases be owned by IWG, the parent entity, they're actually owned by separate smaller entities that they can basically bankrupt or get out of the lease without any pain to the or any recourse to the primary company. So what they did in 2020 is they bankrupted 97 of the sub entities, so to speak.
Hmm.
And obviously, this year their free cash flow is doing well. They're a company that runs very well. So the CEOs even said in interviews, I think the numbers like 95% of their loans they have are non-recourse to the IWG firm itself. So I really like that model because it does reduce a lot of the risk, I think, to the model.
Reminds me
Uh,
of shipping. Reminds me of shipping a bit with all the individual ships in a fleet, all having separate entities.
is that how it works? I don't. The only exposure I ever had to shipping, like, because I've never paid attention to it, was Zim, and I was like, all I know is people that actually knew shipping were like, "Don't touch that stock." But
The thing with shipping was they all had really, because there were so many different companies, they called them all sorts of different names. So I think there was one that was like all of the Greek gods or something. Each one was a ship. Do they do
oh,
it? Do they
it's
do
so nice.
interesting things like that with their companies at IWG?
Oh wow, yeah, exactly, and it protects the firm and it protects you as a shareholder. Um, and I don't know if I talk about this later, so I'll just say probably because the CEO and founder still holds 30% of the stock. So he probably wants to set this up in a way that's beneficial for the shareholders, as this is his primary source of wealth. Some people, it's hard to tell. There might be a billionaire like the owner of Asana. He founded Facebook. Yeah, he has a huge share in Asana stock, but what's the share as a portion of his net worth? For
Hmm.
this guy, he founded it still when he was relatively um, not super wealthy, and a vast majority of his personal wealth comes from this, which I think is a good thing to know as a shareholder. Um, One of the things that makes valuing this company or understanding their financials difficult, and by the way, as I go through this, feel free to stop me at any time, ask any questions, or if there's. But one of the things that makes them difficult is the IFRS 16, which is very similar to ASC 842. Like I said, I'm a CPA, so I'm kind of more familiar with the ASC 842. But they're very similar, which is for these leases that they have, basically what you have to do as an entity is you recognize that lease as both an asset and a liability, and then you have to depreciate the asset over the life of the lease. But it's not truly an asset, like it's a lease you have with another organization, but this way it makes sense why they did it, why the governing bodies wanted it this setup, but it makes reading certain companies' financials like an IWG difficult, because what happens is a lot of their rent expense and things are going to be kind of captured in that depreciation expense. So then if you back that out, it just makes their financials maybe look very different. And so you kind of have to come at it from another angle. So
It
just,
makes things like the yeah adjusted EBITDA or whatever kind of
yeah,
quite inflated, doesn't it? It makes it appear quite inflated.
yeah, it definitely does. And I would personally, and I'll show us, is look more at something like an operating cash flow or cash flow from business operations as a better way to look at this company than EBITDA, because of that reason. It's just funky, especially with how it works here. So I think this is an example showing what, you know, if you look at this company's balance sheet initially, it looks terrible because you see a little bit of cash and you see like 7 billion of debt, but it's not really 7 billion of debt. It's really this net financial debt here. I guess you could say that the 873, but that's the kind of their net debt is really about 650 million, and they have this roughly 6 billion of debt that's really capital leases.
And as
So
you said, those leases are all linked to specific entities as well. Um,
correct,
so they're siloed.
exactly, 100%. So it's not even like true recourse to the firm, because if any of these leases became a big issue, they're just gonna get rid of that entity, or cancel a lease with a certain amount of lead time. But either way, it's not really ever going to become an issue for the firm. And at the end of the day, for me, the best way to describe all this for someone looking at it is financial noise. Like you kind of just need to,
Mm.
that's why I prefer, and I don't know if I put on the next slide. That's where I put, oh, well, that I was explaining, that's why you're often going to see like a loss. So they're often going to report a loss when you have this massive amount of um, depreciation and um, finance, which
Amortization, yeah.
yeah, the financing, because what you do is you recognize depreciation and the finance. They have like a finance portion, which is really the amount that you're, as far as I understand, kind of actually paying is the finance amount. But it just kind of makes a lot of noise for these financials. That's why you see like a loss for the period of, roughly 60 million, whereas their cash flow was a positive, I think from operations was about 110 roughly million. Um, and that's why, you know, what I tell most people is don't pay as much attention to this because you're going to get lost in the weeds trying to understand it. Even management has said like IFRS 16 makes our financials difficult. We don't think it's a good representation of the business,
Hmm.
um, which I would agree with. This stuff does add
We
a lot of
just
noise.
Can we just jump back to the previous slide
Yeah.
quickly? Yeah, so with the net financial debt, as you were talking about
Mhm.
the leases being siloed per company, how is the financial debt on the parent company? Is that
The
good with
financial debt is
okay.
so the financial debt is on the parent company, and that's what I would look at as the true debt the company owes. Now, none of this, they're actually in a fairly good position. You'll see they've actually been paying down that debt. That's part of their capital allocation strategy right now because they took, and we'll talk about this more in depth later, but they took on a good bit of debt to, or leverage to buy Worka or the Instant Group,
Right.
um, which I think has been an incredibly smart move. But, um, none of these debt maturities are until end of 2025, and they're kind of paying them down, and we'll see. I don't think these will be an issue for very long. Um, we'll get to that in a little bit. But basically, they're looking to spin off or sell part of that Worka group, and I think the amount that they're going to capture will more than be enough to clear all that debt.
Is that something?
Um,
Are they using like a revolving credit facility, something like that, for that funding?
um, they broke it out. They have some revolving credit, but most of it was a um, just standard debt facility that matures in 2025 or end of 2025.
Okay.
Um, so you know how these are usually they have an amortization schedule of maybe 10 years with a balloon payment at the end.
Hmm.
And so their debt, the nearest maturity is 2025, but there's a little bit on revolving credit, but most of it isn't that. Um, but I'll go because the one thing I think it's this slide, is the one that I like to best understand what the company is doing financially. And ultimately, I'm a cash person. That's what, if you're a shareholder, how they're going to buy back stock or pay you in dividends or do anything. And so I think this is the best way to understand the company. Um, and I don't think it's some companies, their cash flow can be deceptive, so to speak, because maybe they have good cash flow, but a lot of stock based comp. This company has near zero stock based compensation. In fact, over the last 2 years, their stocks remained almost flat, but it's actually down a little bit. So they're buying back an incremental more amount of shares than they're actually issuing. Just, that's a lot of, I get that question a lot. Um, so you see about a cash inflow outflow before growth, capex, and corporate activities. And so, 109 million for the first half of the year is really what you're looking at in terms of cash from operations. Um, and then, they put a certain amount of that into growth capex, which makes sense. And then they paid back. What they did with that cash flow was pay off a lot of the debt, and that's kind of what management is saying they're going to do. But if you look at that and you run rate it, I mean, if they can, and I think they'll be increasing the amount of cash flow they'll be getting, but 109, well, let's call it 110 million. You're looking at about a 220 million run rate. cash flow from operations business that's trading at an enterprise value of about 2.3 billion. And so that's a run rate of about 10 to 11 times cash flow, which is I think very cheap for this business, especially with the levers that they have that will, I think, unlock value. So what they are doing right now is, you can see in their most recent report, they talked about the new center openings that they're doing. And so you can see that last year they signed 123 new centers. This year it's at 400. And that's just in the first half of the year. So they're rapidly growing their center, the amount of workspaces that they have. And the reason they're able to do this is they kind of changed their model in the last 2 years of how they're going to open centers moving forward. So the traditional method was we are going to go to an office space in center London. We're going to rent out a floor, and then we're going to sublease that out to different people, maybe, to hybrid workers. What they're doing now instead is they're going to these different companies and saying, hey, you're having a hard time filling these floors. What we'll do is we'll be the management for you. So we don't actually have to put any money into this, where it's like a management fee for these different locations. So what's happening is now with kind of COVID and all the open office space, they're getting a bunch of companies coming to them and asking for that and saying, hey, can you help us fill the seats on these floors? So that's why they're able to open at a much faster pace. And that's why you can see there it says, the total new center deals signed, of which are capital light. Almost all of their capital light structures is what they're going to be doing moving forward. So almost, like I said, almost no CapEx investment. And that's why if you look back, I'm going to go back real quick. Even though they're opening up 200% plus more locations, the net growth capital expenditure is down by like 40% because they're not having to put that capital up front. And I think for this company, that's an amazing, it lets you scale faster, and it's a lot less risk to the firm. And then also it's going to improve your margins. So for me, I think it's a great model. So I
I
go
think
next to Worka.
I just wanted to say, I think you described it quite well in your discussion on your YouTube channel, when you talked about it being similar to the hotel business,
Yes,
about moving towards that kind of model, almost like a franchise approach.
that's exactly it. So a lot of people don't know this, but if you think about the big hotel chains like Marriott, what they do is they don't actually own the hotel. They have a franchisee who's the one that owns it, and they're more of the people that are running it. Oh, you see, it's a Marriott. I know what a Marriott's going to get me, so they go there. And so it's more like you said, like royalty income or franchisee income, where they're the name, but they have franchisees or individual partners who are going to be actually putting up the capital and having to run these. And I think it's a very, the hotels is a great great analogy or similar style.
Hmm.
um, yeah, I'm so glad they're moving this model. I think it's a lot better than the previous model. Not saying anything against it because they've been running it well, but I think this is a really exciting avenue for them.
Yeah, it's interesting because when you compared it to WeWork, I kind of thought a bit that perhaps it was the capital light approach that was allowing them to be profitable, but it sounded like they were still managing
Mm-hmm.
to generate free cash flow and so on, even when they were doing the lease model.
I, if I'm going to be honest, I think the reason is so this company's been around since '89, and the way that they've gone through this. So going back a little bit, if you go through their history, and maybe I should have talked about this, they went through a similar situation as WeWork. I think back in '99, they actually declared bankruptcy, way back then. So Mark Dixon, he founded this company. They were kind of going through this ultra growth space, kind of like WeWork was, and they declared bankruptcy. And then he kind of learned, okay, we did this wrong. We're going to do this and try to be profitable moving forward. And so I think it's just a complete change in sustainability. So um, I don't know if you've watched, there's a WeWork documentary, I think on Hulu or one of those, but WeWork was burning cash because they were getting checks from, SoftBank and big
Hmm.
investors. And so once that capital dried up, that's really what WeWork, that's what hurt them in the end
Yeah.
was they were running an unsustainable model. And, they were thinking we're going to get more investment from venture, I don't know if they call it venture capital, but, other sources. And they were a cash burning business. In fact, they still are a cash burning business. IWG has built this company saying we're going to be profitable. This isn't something that we're building on the backs of VC checks. This is something we're building on the back of running profitable centers, running a business that, and I think that's why Mark set this up so that he can bankrupt poorly performing ones if he needs to, because that way, um, in a situation like a 2020, you get rid of the entities that are just dead, and then you can move forward as a parent organization.
So yeah, if they went that's a couple of questions come to mind there then. So one, did the with the management, as I understand it, the WeWork management are pretty cavalier, with and pretty profligate with their spending.
Mhm.
So was there a similar kind of approach in the early days of IWG as well?
It's hard for me to find a lot on that because it was 25 years
Hmm.
ago. But my understanding from what the CEO has said was I don't have the direct quote, but paraphrasing somewhat is people have asked him, obviously he gets asked a lot about WeWork. And he said more or less, yeah, we know what WeWork's doing. We know it's not sustainable because we've done that. It was like kind of his paraphrasing what he kind of said.
Okay.
Um, and so my assumption was it was probably similar, especially if you think that time that was like the .com bubble and all of that fun stuff. So it could have been just growth, kind of similar to 2020. I don't know. I wasn't around, or I was around, but very young at the time. Um, so I don't know for sure, but my understanding is something similar.
And when they declared bankruptcy, do you know much about how the founder was able to retain a large stake in the company? When did he have loans to the company perhaps or something as well that he was able to convert into a stake?
I honestly don't know. Um, Not entirely sure on all of that. I would have to go back and maybe do a little more research. I think that's a really good question just to see what the how he retained because he has a large percentage in the company now. I think I'd have to go back and look at that
Hmm. Okay.
ultimately.
No worries. Anyway, it doesn't really
No, I think
affect
it's a
the
great question.
doesn't
It's
really
kind of interesting.
affect the thesis going forwards, but yeah,
Mhm.
just an interesting thought.
Yeah. Um, but and so I can if there's I can move forward to the Worka or Instant Group, which I think is an interesting part. I don't know if there's anything we want to talk about the core company before we move to kind of that acquisition and
Um, well, it might be good just to so have you got a slide on their other brands as well? So it might be good just to get a bit of a picture of perhaps because they do have
Mhm.
quite a few brands within their stable, as I understand it.
I don't have a slide, but I can just pull up because it's on their website. So give
Hmm.
me 1 second. I'll just pull it up and flip it over here. Just kind of their all the brands they have.
Yeah, it'd be good to know a little bit about perhaps sort of maybe prior to the Instant Group um
Hmm.
investment, sort of which ones were the more dominant contributors and
Oh yeah,
so I understand it was originally Regis, that was the sort of founding brand, and these
right.
other ones have they all been acquisitions that have been added on, or how has it worked?
My understanding is they do some acquisitions. So Primarily, these have been acquisitions maybe when they were slightly smaller, kind of a tuck-in acquisition as opposed to maybe like a bolt-on,
Hmm.
which Work is more of a, I'd say more of a bolt-on acquisition. But yeah, so looking back just at, they haven't done any big acquisitions in a while, but that's what these have primarily been, is my understanding is, start off as Regis, and then for most of these, maybe when they were smaller, they acquired them and then helped grow them out. The bigger contributors here, obviously, Regis and Spaces, as well as these four, HQ, Spaces, Signature, Regis, are kind of the bigger drivers of revenue. And they might have it in their annual filing. I didn't break it down to see exactly the breakout, but I know those are the four larger brands that they have.
Okay.
And then they have these kind of, I'm not going to say ancillary, but smaller ones that are more, whereas those other brands are more international. These are somewhat more based in certain countries, more national. So you have this one, Baseport, that's more England and Wales. Shop at Work, France. So kind of different um, EMEA locations, and then a couple in Southeast Asia. So you have Biz Dojo, Open Office, that are more, Asia focused,
Got you.
and yeah, those are the brands. But I'm sorry about that. So those are kind of the main contributors there to who IWG is and how they make their money. Um, Anything else on that before?
Um, no, no, I think you covered it nicely there.
Perfect.
Yeah, so I think we can probably should we have a look at the we were discussing the instant group and worker platform.
Yeah, sure. So, and the next thing is, so Worka is, they bought this company. They were originally the Instant Group, and they bought or merged with them back in 2022. They paid about 350 million for them. Now, the or Instant Group slash Worka, the management there also made a $50 million investment to buy out the private equity funds that owned them. So it was a combo from both IWG and Worka, or Instant Group, directly to do it. So they're still by far the majority owners in it, um, but they aren't the only ones. Now, when they bought this, they were fully planning on spinning it off or selling it, IPOing it, something like that within 2 years. And management still says that they're planning on doing that at some point, um, but that it's been operating better than they thought. And I think they're letting it get up a little bit, maybe so they can spin it off, IPO, private sell it at a higher amount. So and I have here already have, oops, sorry, let me go back. They already have offers in excess of $1 billion. I know in November 22, they got an offer to buy out the whole thing at 1.5 billion. And as recent as maybe January, they got an offer for partial at about 800 million. So, in to me, that's a really nice thing to frame this, because one of the problems with situations like this a lot of times is you find a company, they look cheap, they're operating well, but they perpetually trade at a low multiple, or you can't unlock value for whatever reason. I think if they take this and they sell it, they IPO it, that massive influx of cash is going to just allow them to realize value however they want to do it, if that makes sense. Um, Looking at the actual business of Worka, and what it is it's an app that allows someone like you or me to book hybrid space, and it's connected to about 35,000 different locations. So the way that Mark, the CEO, has explained it is, he calls it, I think it's a little hyperbolic, but like the Uber of hybrid workspace. So you go on there, you can book a Regis office, and it's not just IWG's brands.
Hmm.
Um, IWG's brands are exclusive to Worka, but Worka's not exclusive to those brands, if that makes sense.
Got you.
Um, over the last year, they've grown at about 35%, and their run rate is about 120 million of EBITDA. So if you think of, I mean, I mean, not that they're the same thing, but what did Instacart just IPO at? Like what multiples? Um, so I think something like, a 10 to 15 times multiple on their run rate EBITDA would be more than reasonable, something to sell them at or to IPO them at. And so if you do that, the amount of um, cash that you're getting in, the amount of um, value you're unlocking, I think is quite a lot there. And I think that's a really good opportunity. Like I said, for that company, they do this, that debt that they have, it's no longer an issue. I think we had talked about the 650 million or so of debt. I mean, you can easily IPO this company and then you're going to be able to pay all that off if you want, or do a dividend to shareholders, or who knows what. So I think that's been that this is a really interesting part of the business to me.
Would it be more valuable as an internal asset though? In the, as you were saying that IWG's offices are exclusively listed on the Worker platform. If it was then
I
sold
think
off, would that losing that control over the direct contact with consumers, do you think that would be then a disadvantage for the remaining business?
it could be. One of the things management has talked about in response to this is maybe doing a partial sale. So one of the things, and I think that personally, I think that it's a win-win either way. I think if they keep Worka here, especially at the rate that it's growing, the margins that it has, they haven't. Um, I could pull it up. I know, like they're at about, I want to say 150 million to 160 million of revenue, and they're turning that into about 120 million of EBITDA. So obviously, software type revenues or margins. So either way, keeping that, um, or maybe that's gross profit. I should pull it up and double check. But either way, really high software esque gross
Mm.
margins, and so if they keep that internal, I mean, it's going to generate cash for them. So either way, they're looking at what I think was an asset they were able to acquire and bolt onto their business at a really attractive multiple when they got it. And now they're able to either, like I said, spin it off, IPO it, or keep it internal and make money. I think management still wants to IPO it, but we'll see. Because in the last trading update, management kind of said, no, we're still planning to do it in the future, but it's performing better than we expected. So we're going to hold on to it for now. It's kind of how they said that.
Hmm. I suppose another option would be like, yeah, if they spun it off and then didn't issue any additional shares, but effectively gave shares to all of the current IWG shareholders
Mm-hmm.
and the other entities in there, they could do something like put the debt onto the balance sheet of Worker, and then so it IPOs with the debt, and as often it kind of happens, yeah,
Yeah, you hold Warner Brothers Discovery, right?
yeah, that's an example, yeah.
So, yeah, that's yeah. So exactly they could do that. I don't know what their plans are, but that's not a for IWG shareholders. That's not another bad alternative either, because then they can still control a good chunk of it as a primary shareholder, and then
Yeah, and it should the whole thesis would be that this effectively uh software platform is going to command a higher valuation multiple
Mhm,
than IWG would. So yeah,
right,
they'd get capital gains from the shares they were issued potentially. Yeah.
exactly. So I don't know. I To me, this is a really exciting aspect of it either way. Um, so
I did
that's Worka.
another question actually. So with the capital light model,
Mhm.
um, what are the actual what's the actual offering that the IWG is providing to the landlord of the office? Are they if it was just distribution, then what's the advantage of going through IWG versus them just listing it themselves on Worker, for instance?
So there's a couple things. It's not just distribution. What I'll say is it's expertise. So one of the things that people, because it's funny, all the questions that you're asking is like things analysts have asked in prior earnings calls. So it's like good questions because obviously that's front of mind for some people. So one of the things management has said in response to this is that um, running a hybrid working space model is very different from being a building owner and running a 5 to 10 year lease model. There, there's an expertise that IWG has from doing this for as long as they have. Knowing how to fill that space is what IWG is doing. So it's not just the distribution, but it's also the expertise of management coming in and saying, "Hey, we know how to run these. We know how to make these work for you." So where I might own a 50-story, building in some big town center, that doesn't mean that I know how to do a hybrid working model. It's very different. So that's what management has said. Um, it's the ability to um, have the knowledge, and then also I would say, I think this also helps is if you're plugging this in. Let's say you're a Regis, like they put a Regis in your building. That's the brand you're going to go with as an
Mm.
example. Well, then if I'm a hybrid worker and I do this, now I have access to the whole part of how these work is now I have access to the entire Regis network, right? So instead of just being a hybrid worker, having access to your one building in whatever city you're in, I now, if I work for Microsoft, now I can, if I have, a Regis contract, my employees can go to your building there, and they can also go to, let's say that building's in California, they can also go to London, to France, to all these different areas. So there's also a bit of a network effect, as much as I hate that term, within IWG itself.
And are there any kind of is there any kind of wholesaling stuff going on? Like I know a lot of franchise businesses, like I imagine it's probably true of the hotels. Maybe a lot of the supplies are provided by the
Mhm.
the franchise, or a
Yeah,
McDonald's or something like that. It's all normally supplied, which is why they're all pretty much maintained equally. There's things like desks and general branding and stuff and decoration stuff all provided
yeah,
by IWG.
yeah. So part of that, um, what's the word? The contractor, that the management contract is that IWG will go in and um, fit the space, so to speak. So,
Okay,
like you say, the procurement, I guess would be the word, or the outfitting is done by IWG. They're not fronting the bill for it, but they're the ones that are bringing in, like you said, maybe the procurement, supply chain, or the wholesaling that allows people to outfit those um, at either a cheaper rate or just to match the other spaces and make them in a way that people actually want to come and work at them.
got you. Okay, yeah. So that is a pretty good offering, then. Yeah.
Yeah. Yeah, and I think I say this later on, but in the last trading update, the management said that they have about 10,000 to 15,000 of these capital light centers in the sales pipeline.
Wow.
So, yeah, so there's definitely interest in it. The way he puts it is he goes, it's really hard as a CFO, and I know what he's saying here. It's really hard as a CFO to go to people and say, we're cutting costs, and then have everyone celebrate why you're cutting costs. So you go from, directly leasing a place, in California, saying everyone has to come into the office 5 days a week. You say, oh, instead of do that, we're going to do a hybrid working model. So now you only have to come into the office 2 days a week. People are going to love that, and you're also saving money. So from a purchaser standpoint, it's also a great, benefit. So there's a lot of
Absolutely. Yeah.
demand right now for this. Um, I don't know. Oh yeah, this is just like, and I think we may have talked a lot about this already. But kind of like what management is saying is their strategy going forward is that capital light, asset light model. Um, you know, it allows them to scale more quickly as they don't have to put anything into it. It's just they're bringing in teams to say, okay, here's how we have to fix this up. If you're the one actually doing the lease, actually having to front the capital, obviously that puts a constraint on how quickly you can throw up and put up all these different locations. But if you're using the funds for somewhere else and it's ultimately not really a capital risk for you, it allows you to open these up more rapidly. And we talked about the Worka different options there. One of the things management has talked about, and we didn't talk about this yet, was they want to report in GAAP instead of IFRS. So they've talked about doing GAAP reporting. And they've also mentioned back and forth about potentially listing in the US. One of the things that could be nice about that is US listed companies generally get a valuation bump. So if you're someone and you go list there, the reason management has talked about that is their number one single country that they get revenue from is the US. And I wouldn't be surprised to see if the US will be kind of in dollar terms their fastest growing area, because I think a lot of the WeWork implosion is creating a vacuum for them. I know they're picking up WeWork locations and refitting those, but management has talked about that. And then what they do is, like I said, strategic buybacks or debt repurchasing. So I mentioned this previously, but or a dividend, just strategic return of capital to shareholders. So they are a net, it's easy to say net diluter, I guess net buybacker of stocks. But the share amount has gone down over the last years. It's by a very tiny amount because they only buy back a few amount of shares, but the majority of management salary is in pounds or in currency rather than in stock. So management has a very small amount of stock compensation. Now, that's not to say that they're not investing in the company. Like I said, the CEO and founder still holds 30% of the company, but they're not diluting you. And I think that's I think the CEO wants that because he holds so much. And anything they really do dilute, they repurchase back is how I've seen it so far. But currently management's guidance is that they're going to spend most of their focus on delevering the balance sheet and kind of getting, rid of that debt so that they can, just no one likes to have almost a billion pounds of debt on their balance sheet. Doesn't feel good. So that's kind of what they're focusing on paying off there. That's kind of where they're going right now. For me personally, I do think it's a company that's firing on all cylinders on these different objectives. I think the rate that they're growing these non-capital intensive centers at, and the growth that we're going to see in margins and in bottom line dollars as a result of this will be really good for shareholders. I think just valuation, like I said, trading at roughly 11 times current run rate cash from operations. And that's on a company that's growing 15% top line and expanding their margins. So you're looking at 15% plus growth. And then moving to that capital light model, which is going to reduce risk, which should also help valuations. So I don't know any questions on any of that. That's kind of the summary right there of the company. And then I have just a couple quick risks here, but
no, I think you covered the valuation nicely there. Yeah.
And so obviously, just quick risks is if there's a global recession. I mean, technically that's a risk to anyone, but you're going to have less employers hiring less seats, which means less revenue. Obviously, as a hybrid worker, you get paid off the seats that you fill. The thing about that is I don't think we can go through anything worse than COVID for this space. And the way they went through COVID and handled it, I thought they did quite well. Obviously, it's not a time that was great for them, but if you look at how they came out versus how the rest of the industry came out, I think it shows that their model is superior to others in the space. And then I have two smaller risks that I don't really think are complete risks, but they are there. Is one, I guess, if employers decide, and the return to office becomes a full return to office rather than a hybrid or allowing people to work from home. most employers then would probably just do full long-term leases on their own, rather than doing a hybrid working model, and that could cut into how many people actually want to use IWG. Don't personally see that happening, but it could happen. And then the other is that WeWork survives and puts more pressure on margins. One of the things that's happened to IWG in the past 5 years or so is you had this WeWork who was thriving off of losing money on their business, which obviously meant they could run these centers at lower margins because, well, they're running at negative margins. And so that put pressure on IWG because IWG then has to respond and either offer, a more impressive product or cut back on pricing and hurting margins, or at least allowing them not to improve margins. So if somehow WeWork survives, which based on their last earnings call, I wouldn't bet on that. It was pretty bleak. I don't know, 12-minute long earning call where they wouldn't take questions from analysts.
Right.
So, but that to me, I see as main risks. I mean, any company has execution risk, anything like that, but specific risks to them, that's what I'm seeing as the primary ones. Nah, I think that's all I have. Yeah.
Yeah.
So,
So yeah, on the competition front, then,
mhm.
so it's looking pretty likely WeWork would go. Well, yeah, a couple of points. So with WeWork, does WeWork currently have more offices than IWG in its overall estate?
I don't think so. Let me see. Because WeWork's been cutting back really significantly on they're only at, so I don't think WeWork ever had more locations. WeWork's locations were just like more, WeWork was always focused more on city centers, on, I would say, like impressive locations, so to speak. So they only think
Hmm.
topped out maybe at 1,000 or 1,100, something around there,
Oh wow.
locations versus. I could be wrong on that. I can double check, but let me see. WeWork.
Another thing I think I heard mentioned about IWG is that you triggered the memory there with the talk about city centers. They do focus on, or they have more recently focused on expanding into rural areas and stuff like that, which is
Mhm.
going to be closer to where the employees are going to be wanting to live and so on. So they
Right.
were like
So
listing a few different places that only had like 10,000 people living here and all that kind of stuff as examples
right.
of the model.
No, they're doing that. I actually, you know, like that. So WeWork could obviously never do that. That's not something competing with WeWork because WeWork was always this kind of. It was like trying to mix. In some ways, I felt like Silicon Valley with a New York, which is like two very different kind of things. But they started in New York, but very in some ways Silicon Valley feeling. So, but they always focused on larger areas. So obviously, New York, they still have like 100+ locations there. Um, IWG is more on, it's not trying to be sexy for lack of a better term. It's more saying, hey, this is a working space. We're not going to have beanbag chairs and all this kind of,
Mm.
free beer for you in the fridge, um, which I think was one of the reasons, WeWork ultimately failed. You can't offer that, sustainably necessarily. Um, but yeah, so one of the things that IWG has talked about is in this hybrid working environment that we're moving to as, globally, people want to be able to not have to drive an hour to work and an hour back, or, in other countries that aren't, as car focused as the US, have a commute that's an hour each way or 45 minutes. If you put a center near to where, 10,000 people, 15,000 people are working in the suburbs of a larger city, then they can just commute there, take 15 minutes, which is a lot easier for people because people don't hate necessarily drive or going into an office all the time. In fact, a lot of people, they want to work 2 or 3 days a week in an office. The problem is driving, 45 minutes, spending all that time in rush hour traffic, getting there
Mm.
and back. This has been the point of Mark. And so if you put these places closer to them, you can get good results. And obviously, smaller locations, they're not going to be these fancy things, but people are just looking for an office space. They're not looking for this super extravagant thing. So that's kind of they have been doing that. But they also have been, I know in the last earnings call, they said they have taken over about 50 WeWork locations. So they're doing both at the same time, um, kind of picking up, because WeWork is, what WeWork's strategy is right now is kind of either selling off the locations or getting rid of them as quickly as they can if they're not being profitable, or getting people in to these locations, whatever the cost. So WeWork may be cutting price for people to come in. And the CEO said, there's been some margin pressure in some select areas because of that, but he doesn't see that as something that will last for a very long time. I don't know if that just means
Yeah,
he doesn't
yeah.
think WeWork will last, but
And
um,
something that people talk about quite a bit when they're talking about hybrid working and well, the merits of the office, let's say, is
mhm,
that face to there are certain things, maybe more collaborative activities that are better off face to face. So that model of if you were having more localized offices, that potentially wouldn't provide that benefit. So there is still a need to have the centralized ones, I guess, which people would travel to in order to
mhm.
still have that face to face stuff. But I guess where the hybrid element comes in is that you wouldn't need all the people in all the time, and so a smaller floor space, any one time being occupied, it would be sufficient. So you could just get people to come together to a communal place in the city center, um, but different teams at different times and what have you, and so they wouldn't need a big building that was occupied all the time. So I guess that's where that comes from.
No, that's exactly it. And you know, don't like divulging too much of my personal life, but my wife works 100% remote. Just as a simple example,
Hmm.
and she tells me like I would love to go in the office 2 days a week, but she works for an employer in another state that's rather far away. So but people want to be able to do that, leave the house, go into an office a couple of days. At least my personal anecdotal experience is that. Um, and I think having those locations near different, more rural or more just smaller cities is helpful. And then, like you said, you can still have meetings where everyone goes to the big, building. We're having a team, collaboration event. Everyone comes into the big office, but that's not. They don't have to do that every day, and that's
Hmm.
that's the big value add right there.
And that big office could still be a Regis one or something anyway, couldn't it? It could just
Mhm.
be a separate space that they rent out independently because of the flexibility of being able to move around different locations and so on.
No, that's exactly right.
Yeah. Um, and yeah, you mentioned with the worker app, did you say there was 35,000 um centers on there?
Yeah, I can double check, but 35, unless I am.
Yeah, it's obviously something like 10 times what IWG has in their estate. So uh and WeWork is only around about 1,000 or so. So what sort of makes up the rest of those um, hybrid spaces? Are they all just like a few independent centers, or are there any other big players there?
There's a lot of small players. There's no real large players. I mean, outside of IWG and WeWork, those are the two biggest for sure. Everything else, if you look it up, it's a lot of small little decentralized. Um, I don't want to say mom and pop, but smaller hybrid working stations.
Okay.
I remember in the capital mindset community, we were trying to look up like who are the big competitors, and everything we looked up, it was just like these tiny. Outside of WeWork, it was a lot of like small little um, brands that I had never heard of. Like if I looked up like IWG, yeah, yeah. So the competitors, the bigger ones, I guess, is like Seats to Meet, which I've never personally heard of. You know, Olivia Center, REL Technologies, and none of these are big. So there's a lot of just smaller mom and pop decentralized locations.
Mm. So I guess quite a lot of opportunities there for just rolling up some of those
For
smaller ones
sure.
then for IWG.
Yeah,
Yeah.
if they want to do that, either rolling them up or just, in my opinion, the value proposition from an IWG is going to someone and saying, why would you use someone else when you can, like, I mean, they may be cheaper and that might be the big thing, but why would you use someone else who's only local, that they're only in one city, when you
Mm.
can use us who has a international network? So that's kind of, I definitely think they have an advantage there.
Absolutely. Yeah. So do you think there's anything else we should touch on? I think that's pretty much everything I can think of.
No, I think that's about it. I hope I summarized it well enough. I know,
No, it's,
but
you're the first person that's come with slides, so that yeah, that was immediately a leg up.
there we go. No, well,
Um, so yeah, maybe we just finish then with do you want to just tell listeners where they can go to find out more about you and Capital Mindset? You know, you mentioned YouTube. Do you want to talk about where the name of your channel and everything and wherever else and Twitter or anything else you're on?
yeah. So we have relatively, at the moment, small Twitter presences, although we're trying to build that up. But you can either look up, my name is, Andrew Marshall, and you'll be able to tell who I am. I work with Capital Mindset. I have that in my bio, or just look up Capital Mindset on Twitter or on YouTube. On either of those platforms, the YouTube one, we should come up right away. And then, yeah, if you see those and you think it's interesting, yeah, check out our videos. Like I said, you should see myself and my partner Fabio on there, as well as Leo if he comes on any of the public ones. But yeah, so Capital Mindset on Twitter or YouTube. That's where you'll find us.
Excellent. Well, thanks again, Andrew. It's been a very interesting company. Yeah, and we'll have to get you on again in the future if you're agreeable for when you've got another stock to pitch.
Oh, oh, for sure. No, I mean, thanks for having me on. I appreciate it. And like I think we said, I just like talking about, I'm a nerd. I like talking about stocks with people that are actually interested in making money off of stocks. So thanks for having me on. I really appreciate it.
All right. Thanks everybody for listening.